Welcome to the Allan Small Financial Show. As always, I want to thank all of you for taking the time out of your busy day to spend it with us. We have an information-packed show for you today. Probably I was thinking about it coming on air. We probably have more illustrations on this show than we've ever had in any show before. I'm a very visual person. I always like to show what I'm discussing or talking about. I think it's a lot easier to understand the topic and the information when you have a chart or some sort of diagram that goes along with the information. So we have a lot of information for you today. Here it is. We're going to be talking about Trump's tax and spending bill that was just passed. They call it the One Big Beautiful Bill. What does that mean for investors? What does that mean for Canadians, Canadian investors? What does that mean for all of us here in Canada? What do tariffs and the passage of the Trump spend and tax bill mean for Canada? That is our second topic. As always, our top three things to consider over the next 5 to 10 business days. These are three ideas that I think individual investors need to keep an eye on before you make your investment selections. Number 4, US dollar stumbling. It's the worst start for the US dollar in 50 years. Unbelievable how weak the dollar is. Weak versus the Canadian dollar, but even more weak versus a basket of currencies of all the major countries around the world. We received some mixed U.S. job signals or U.S. job data over the past week. We haven't received the Canadian jobs data as yet. That's going to come on the 11th, this Friday. But we received U.S. jobs data last Thursday, and it was definitely mixed. Perhaps a cause for maybe just a little bit of concern. Quick hits, three things that some of you may have seen in the news recently. I'm going to comment on each of those. And last but definitely not least, your questions. If you have a question during the show, something that I spoke about, something that you want to ask about, please put it in the chat box and we will pick those questions up. And I will try to answer one or two questions at the end of the show. And if I don't get to them at the end of the show, hopefully we can get to them over the next couple of weeks or answer them on the next show. So without further ado, let's get moving with this information-packed show for today. So the big beautiful bill, this was passed in Congress not that long ago. And for those that ask me, are you surprised to see this bill passed? Absolutely not. I think we all knew that this bill would be passed because it extends President Trump's tax cuts from his previous term. These tax cuts were set to expire shortly, and the passage of this bill allows those tax cuts to extend. And that is obviously a good thing for the American people. This tax bill also added some other things, such as no tax on tips, something that President Trump campaigned on during his campaign for the presidency. No tax on overtime. We talk a lot about here in Canada how, because of the high tax rates, that all those that are offered to work overtime, to receive time and a half for their work, many people say to me, you know what, Allan, why would I do that? A lot of my overtime pay will just go to taxes. So in the US now, no tax on overtime. That is a very big thing and a very good thing, I think, for business to have people work overtime and want to work overtime. It allows the business to be more efficient. There are also I don't want to say tax cuts, but other tax credits, if you will, or tax breaks. Maybe that's a better way of putting it. If a company now were to purchase, let's say, something for the business, whether it's a new truck or some sort of equipment, they were able to write off that purchase over a period of time, amortize it over a few years. Now, President Trump has allowed for these businesses to actually write off that purchase in the year of the purchase. So it's not something that you would have to amortize over the coming years. You could actually amortize that purchase right then and there. So a lot of positives, in my opinion, pro-business positives from the One Big Beautiful Bill. The one big negative, actually, is obviously the amount of debt that this will bring to the United States, the amount of debt increase in debt levels. I've seen it as much as 4 trillion. We're going to show up a chart shortly that will show as much as $4.5 trillion of I guess, spend, of indebtedness that this tax bill will bring on. But interesting comment out of Scott Bessent. And I think this is something that, here in Canada, we can kind of take a picture or use this as an example for us up here in our country. And what Scott Bessent, Treasury Secretary, said is that, yes, this bill will, I guess, unfortunately, increase the debt levels in the United States, but this is good spend or good debt. And what he meant by that was he believes that the debt that they're adding to their already very large debt levels will bring on growth. And if you are growing faster than you're growing the debt levels, that's actually a good thing. And actually, over time, it'll help to bring down debt levels. So whenever a country borrows money to spur on growth, to increase business activity, that's a positive. And Scott Bessent, Treasury Secretary, said that this is exactly what this bill brings. And so, yes, initially, debt levels will rise, but over time, they will come down as long as the U.S. can make in and around 3% growth, 3% GDP growth per year. Then they believe the growth aspect of that will bring on more revenue to the government and therefore allow them to pay off debt. So I guess grow your way out of debt, which is something that I've heard Premier Ford say as well, and many others in the Conservative Party up here talked about, adding some debt, but growing, pro-growth initiatives. And this is what the Republican Party is all about, pro-growth initiatives. And that's what Scott Bessent, Treasury Secretary, has mentioned recently. Our first chart actually shows some of the effects of the increase in debt. Our first chart is the U.S. 10-year Treasury. We're seeing that the U.S. bond rate, these are Treasury bonds, 4.41 almost. And we're seeing on the far right-hand side of this chart, you can see that the bond rates or bond yields are going higher. Why would they be going higher? Well, perhaps countries are not buying as much of these treasuries, as much of the U.S. debt as they once were. Perhaps they're concerned about rising debt levels. And so if you have rising debt levels, countries aren't maybe as confident in the U.S. economy as perhaps they once were, as confident in the U.S. dollar. And so we start to see countries maybe not buy as much of U.S. debt, and that has pushed up longer-term debt. You see here the 10-year Treasury bill, 441 almost. We have a 30-year chart here, again approaching 5%. You can see sometime towards the middle to end of May, you can see that debt levels actually reached above 5%. And we know that these treasuries, they affect many things. One big effect is on mortgage rates. When you see treasury yields move higher, especially the 10-year, both countries, Canada and US, we know that mortgage rates are usually set based off of where the 10-year and maybe even at times the 5-year is trading. Our next chart, a very nice one here, shows the whole world and debt levels all around the world. And you can see here all the different colors. The light green, which would be Canada. Then you can see the percent of GDP, so debt to GDP. And you can see all different countries. The United States is beige, that beige color. So you can see a lot higher debt levels than us here in Canada. Some parts of the world like Asia and Russia, we don't have that information. You can see in South America, I believe that would be Brazil, also high debt levels. And again, this is all about debt. Is it good debt? Is it not so good debt? I relate it to someone who has a mortgage, right? Who maybe can pay off some of the mortgage or all of the mortgage. But if you can get a mortgage rate at 3%, why would you want to pay that off if you can invest that money instead and make a rate of return that could be in the 7 to 10% range if you're in a moderate risk portfolio? So paying off your mortgage at 3% or investing it to make 7%. And that's kind of what Treasury Secretary Bessent has been discussing, or at least alluding to, with taking on this extra debt with this passage of Big Beautiful Bill. Our next chart here, and as I said off the top of the show, we have a lot of illustrations. So let's get to our next chart. And this one kind of says it all. This is how fast and how much U.S. debt levels have gone higher in the last, well, I guess going back to the 70s. And really, since 2020, so the right side of the chart, look how steep that curve is. Very, very steep. It's the steepest it's ever been, which means these debt levels have been going higher for quite some time, but even faster. The debt levels have been increasing even faster in the last 5 or so years. I guess there are a lot of reasons for that, perhaps COVID. I know during the Biden administration, debt levels went up tremendously, and a lot of that spend obviously had to do with COVID. Um, but nonetheless, U.S. is at high debt levels. So when you have high debt levels, who is buying all this debt? Our next chart clearly shows who holds U.S. debt. And it's interesting because for the longest time, the biggest holder of U.S. debt was China. China held by far the most U.S. debt or lent the most money to the United States. And now you can see that it's not even close. Japan by far buys the most U.S. treasuries, lends the most money to the United States, buys basically is the lender for the United States, buys their treasuries, as I said, in auction. China is now second. And in fact, I've actually seen some recent reports. This one actually is a end of year 2024, but I've seen as recently in the last few months to say that the United Kingdom, the UK, surprisingly enough, is the second largest holder of US debt right now, ahead of China. And if you scroll down a little bit, you can see Canada is in the number 6 spot. So very important for the United States, these countries to keep buying, obviously, the treasuries, keep buying the bonds that the U.S. is offering, so the U.S. can continue to borrow to fund all the things that it wants and needs to do. Our next chart shows U.S. GDP. And you can see here that first quarter GDP showed an actual negative number, first time in a long time. And no matter how great President of the United States, President Trump says things are going, if we see another negative number in the next few weeks after the second quarter number, that is a negative number, then you will see and you will hear that the U.S. is officially in a recession. 2 negative quarters of GDP back to back, and a country falls into recession. Now, probably say it would be considered a mild recession, but a recession nonetheless. And getting back to, again, what the Treasury Secretary Scott Bessent said, borrowing to stimulate growth, borrowing to get businesses to spend more, to grow their business. This not only helps bring in more revenue to the government when they grow, when businesses grow, when people grow and make more money, because we know that, especially in the US, when they're making more, then they're spending more. The consumer drives the economy in the US, makes up about 70% of it. So borrowing money, the hope is that, at least from the Trump administration, people will spend more, businesses will spend more, drive GDP higher. And as you can see in the United States right now, GDP needs to move higher. Our next chart, estimated increases in savings in U.S. federal spending from the bill. So here I alluded to off the top of the show, tax cut extensions cost in and around $4 trillion, $4.5 trillion. Have some defense spending, some border spending with the border wall. Total savings, there's going to be cuts to Medicaid, $930 billion. The green energy, all these incentives from buying, for going green, buying a green car, for example, electric vehicle, food benefits reductions, $287 billion. Green initiatives, $488 billion. Adds up to somewhere around $1.5 trillion, maybe $1.7 trillion. But you can see that the tax cuts are going to be a lot more than that. And that is the worry. And that is why you're hearing and seeing perhaps countries maybe moving a little bit further away from U.S. treasuries. You're hearing people concerned about the big spend. And you hear government talking about they're going to bring in money from tariffs. They're going to bring money in from growth. And that's what they're going to use primarily to offset a lot of the debt levels that obviously are increasing. Last but not least for this segment, our final chart, which is the GOP budget is unpopular, and every poll asking about it. And on the left-hand side, you can see all the pollsters. And on the right-hand side, you can see how many oppose versus support. So kind of makes you wonder if the people are behind this bill, the one big beautiful bill. I'm a little surprised to see that data, I have to say, because people have to know that if this bill didn't pass, their taxes were going to go up significantly on many Americans. So a little bit surprised by this poll, but it just goes to show you that it's not so cut and dry. It's not so easy. And we're going to hear a lot about what the current administration has done and is going to do over the next year as we get closer to the midterms, to the primary elections, to the midterm elections come November 26th. We'll see what happens between now and then, but that's going to go a long way for all of us to see whether or not the Republicans will continue to hold the majority in both the Senate and the House and allow the president to continue doing what he's doing now, adding his new big beautiful bill and continue with his increase in tariffs on major countries. So what is the big beautiful bill and the tax cuts and the defense spending and all that? What does it mean for all of us here in Canada? And I think a lot. I really do. And our first chart, we can bring that up right away. It shows that we need to do something up here. And I think we could take a page out of the Trump administration's book in a way. We're seeing our economy shrinking down by just below the break-even mark, 0.1% for the month of April. Early estimates, or at least in May, we believe or we know that things were pretty flat. We're just not getting any growth in this country. And so obviously reasons for that would be the tariffs, the sectoral tariffs, the tariffs on Canada. That has caused a lot of anxiety for many people, for businesses doing business in the US. And remember, we send 70% of what we pull out of the ground and what we build to the United States. So when our largest trading partner decides to put tariffs on our goods, that is difficult. It is difficult for businesses. If it doesn't affect you directly, it definitely will affect a business that perhaps you're doing business with. So, you are doing business with somebody and they're being affected by the tariff. So it's interesting to see that what the current administration is doing. They're looking at trade, they're looking at deregulation, and they're looking at, as I said just in the previous segment, taxes. And here in Canada, I think we are looking at the situation similar. We're talking about deregulation. We see Premier Ford out in Alberta most recently working on a deal with Alberta based on trade. We're hearing the Prime Minister Carney, talking about tearing down or bringing down those interprovincial barriers for business, for provinces to do business with each other. And I've seen statistics, and we've had people on our show not that long ago talking about how GDP could increase as much as 6 to 8% based on provinces just being able to do faster and more free business amongst each other. So we are focusing on deregulation, trade. We just heard that our first shipment of liquefied natural gas went to Asia, first time. So we are focusing on trade with other parts of the world, whether it's Europe, whether it's Asia. And I guess in a weird way, we have the US to thank for that. And I chuckle sometimes because maybe the US didn't anticipate that the rest of the world would start doing a lot more business with each other and kind of leave out the US a little bit. We know that the US or Canadian exports to the US, lowest it's been since 1997. And exports to the rest of the world, we've seen that go up 5-10% recently. And I would anticipate that's going to go up a whole lot more. So we're taking care of trade as well. One thing that I think we are lacking to get our country moving and a lot faster, and that is taxes. We've talked to tax professionals on this show before, whether it's professionals from KPMG or anywhere. Taxes is a big factor when you do business in Canada, when you live in Canada. A lot of individuals have left this country because of our taxes. And I think our government needs to focus more on the tax aspect, that three-legged stool. We're working on trade, deregulation, and taxes. Let's take a page out of President Trump's book with respect to taxes. Let's try and lower taxes. I know President Carney campaigned on a 1% tax deduction for, I believe it was the lower tax bracket, or lower two tax brackets, the bottom two tax brackets. Well, that's just not enough. Comes out to a savings of just a few $100s a year. Not enough for a family that's going to really make a difference. So let's focus on taxes. That's my message to our government today. Our next chart here shows income taxes, Canada versus the US. Interesting. And I guess it's not until you get to the tax bracket, 180,528 and above, then you start to see the tax rates sort of the same, 32% versus 33%. This is on a federal level, but the taxes prior to that, especially between 41,000 and 83,000, is 20.5% here in Canada. Between 12,000 and say 48,500, only 12%. Interesting. And you can clearly see that our tax rates are definitely higher than what they have in the US. Our next chart shows the provincial tax rates. Depends on what province you live. You can see the provincial tax rates. Ontario, obviously, being to the right of Alberta and to the left of Quebec there. You can see the provincial tax rates. But probably the most important thing for our discussion about taxes is this red arrow. And it says, example calculation, $60,000 of income in Canada versus the US in 2025. So this would be for an Ontario resident. Federal tax is about $91.44. Provincial tax about $34.70. So the tax would be approximately $12,614. United States, California resident, federal tax roughly $69.62, plus state tax near $24.27 for income tax of $93.89. That is about 25% less from a tax perspective. 25% less. And that is why we're seeing a lot of people moving out of Ontario, moving out of Canada. We're seeing people moving out of some states in the US, New York, going down to Florida, moving down to Texas, where state tax is a lot less. Federal tax in the US obviously is less than we have it up here. Not too long ago, and I haven't seen recent statistics, but Ontario used to be the fourth highest jurisdiction for taxes in North America. And that's not something we want to be fourth highest in. So let's focus on taxes. I think we need to get our government to do so. Our next chart, what do Canadian trade deficit narrows for the US and the rest of the world. You can see here, as I was saying, the trade balance with the US, you can see how it's come down. Canada's trade deficit narrows in April, but stays at near record highs. That is the total trade balance in blue. So it's narrowing, it's going back up, but still at record highs. And with the US, our surplus with the US has definitely shrunk, kind of flattened out there, but definitely shrunk. Our next chart, merchandise trade with the United States is our next chart. There it is on the left-hand side. And as you can see, we're not sending as much. Our exports to the US have come down tremendously. Our imports from the US have come down. And then you can see our exports to countries on the right, other than the United States, and our imports from those countries other than the United States are starting to rise. So is this what the United States wanted? Countries like Canada moving away from the US, moving away from doing business with the United States? I don't think so. And, hopefully things don't backfire for the US, because I think the rest of the world is figuring out how to, I don't want to say circumvent the US, but definitely do business with many other parts of the world, especially Canada. And I think it will only increase. And I think when we look back 10 years from now, I think we could look at 2025 as the year that we saw a turning point in the way Canada trades, the way Canada does business. And I think that will be a positive overall for our country. Now Now the part of our show where I talk about three things that I think are important for individual investors to be focused on before you make your investment decisions. Is trade volatility back? President Trump has ratcheted up the tariffs once again. And just before we came on air, I believe the president sent out another bunch of letters to different countries telling them what the cost will be for that country to do business with the United States. And we've already seen a number of letters go out, places like Japan, places like South Korea, and a number of smaller countries, South Africa and others. And he basically, he meaning the president, President Trump, set the tariff rate. And that has definitely spurred on a lot of conversation. And the new deadline for a lot of this, well, for the trade deadline now is pushed back to beginning of August, August 1st, from first week of July. So we'll talk a bit more about that. Economic data. We have a Canadian jobs number coming out this Friday. Very crucial for what the Bank of Canada may do going forward. Are we seeing jobs fall? Are we seeing inflation rising? We are starting to see a little bit of a rise in inflation numbers, but you mix that with jobs falling, that would be obviously a difficulty for the Bank of Canada. Cutting interest rates perhaps will stimulate and bring jobs, but it won't be good for inflation. Corporate earnings season, something that I think everyone needs to keep an eye on over the next couple of weeks. We will hear from businesses and how they did over the second quarter of 2025. Who starts off every corporate earnings season? The U.S. banks, U.S. big banks. We'll touch on those and what to look for, as well as talk a bit about one big tech company that's extremely important, especially to AI. So let's get into our first topic that I think individual investors need to focus on, which is trade volatility. Is trade volatility back? And interesting that the U.S. is trying to push the envelope. They're trying to get trade deals done as soon as possible. And once again, the president, whether you think he's bluffing, whether you think he's going to go through with this, but he's talking about bringing back tariff rates if a country does not come to the table in good faith and work out a trade deal in good faith. He's talking about bringing back some of these tariffs to maybe almost back to where they were on April the 2nd when the reciprocal tariffs were announced, perhaps just a little bit lower, but nonetheless much higher than where they are or where they were prior to the president taking office. We're also, hearing about countries and trade deals and Japan, South Korea. At first, they were very close to making a deal with the United States, but we're hearing that these sectoral tariffs, so these tariffs on specific sectors of the economy, has thrown a monkey wrench into the whole negotiation. Tariffs on automobiles is a big one for Japan, South Korea. Tariffs on steel, another big one as well. So these are things that countries like Japan, countries like South Korea, they're having a difficult time, crossing that finish line to get a deal done. Our first, almost like a quote, I guess, is from the Yale Budget Lab, and it's the takeaways on state of U.S. tariffs. And it's a very interesting, take. The Budget Lab estimated the effects of all U.S. tariffs and foreign retaliation implement in 2025 through July 7th, including the effects of U.S.-Vietnam trade framework and the July 7th announcements on new rates for 14 countries. As I said, presidents sending out letters. The Budget Lab analyzed the July 7 tariff rates as if they stayed in effect in perpetuity, so that they weren't going to be changed. And what the Budget Lab found out, which, as I said, is from Yale, that the current tariff rate, consumers face an overall average effective rate in the U.S. of 17.6%, the highest since 1934. After consumption shifts, the average tariff rate might lower to as much as 16.5%, which would be the highest since 1936. So even though tariff rates have come down at least a little bit, and for some countries quite a bit, like China, tariff rates are the highest that we've seen in the last, 80, 90 years. The long-run sectoral GDP and employment effects. In the long run, tariffs present a trade-off. U.S. manufacturing output expands by 2%, but these gains are more than crowded out by other sectors. Construction output contracts by 3.5%, so it drops by 3.5%. and agriculture declines by almost 1%. So talking about, these tariffs and what's happening, yeah, some things can get a bit of a boost, but they get more than offset by the declines in other areas. So, for example, aluminum, when the 50% aluminum tariff was announced, we've seen some aluminum producers, their stock rise tremendously. But then you saw on the flip side, those that use aluminum, cars, automobile companies, companies like Coca-Cola, beverage companies that use aluminum cans. We saw prices actually of their stock drop a little bit because their costs would rise. So you always have to look at the benefits and the negatives. Our next chart here is one on reciprocal tariffs. This is tariff rates by the announcement date. So you can see here on July 7th, the rates on all those countries versus what it was on April 2nd. And the two I'll highlight, one would be Japan. They're talking about a 25% tariff now as of August 1st, unless Japan and the US can make a deal. The reciprocal rate announced on April 2nd was actually lower, 24%. South Korea, 25% as well, and it was 25% on April 2nd. So it's going to be difficult for a number of countries to move forward if you're seeing tariffs of 25%, Myanmar 40%, South Africa 30%, and if you couple those with tariffs on things such as aluminum and steel, and now they're talking about 50% on copper. Trade deals need to get done, in my opinion, not only for these countries, but also for the United States. Think about how much and how high the costs are going to go up on many things in the United States. And I'm not so sure that Americans will be waiting for this or anticipating this. And I don't think it's what they bargained for when they elected the current president. Our next, I guess, a bit of a chart here. It kind of outlines how tariffs have gone, kind of a time frame. And you can see here that towards the end there, modified April 2nd announcement, 10% minimum tariffs on all countries, China, Mexico. You see the China tariffs coming off, the 125, the 145. So again, it's more of a, I guess, a time, more of a calendar of events. U.S. Vietnam, July 2nd framework, 25% broad tariff, 40% on tariffs from goods that China sends to the United States through Vietnam. So the U.S. obviously is not dumb to know to think that China will not try to use places like Vietnam to perhaps bring things to the United States, because countries like Vietnam have a lower tariff rate than they do. So on anything like that, you're going to see a 40% tariff on if the United States finds out that these were Chinese goods that were shipped to the U.S. through Vietnam. So volatility back with respect to trade, with respect to tariffs, and I think the volatility will stay at least for the foreseeable future until we get some more clarity. Second point I want individual investors to focus on is the economic data. As I said, we're going to get jobs data out of Canada on Friday, important for what the Bank of Canada does. And we're going to get CPI and PPI, CPI out of both Canada and the US, so inflation data out of both Canada and the US, and PPI out of the US. Very important for what is happening, right? A lot of people believe that inflation will be moving higher. Our first chart here, Canada's unemployment rate rises to 7%. You can see it there, highest it's been, I guess, in a little while. I guess you'd have to go back to 2016, 17. It's the last time we saw unemployment rate that high. I disregard the big spike during COVID. Obviously, that was not, I would call it artificial almost. Nobody was working at that time, so that's why unemployment was that high. But overall, you could see that in Canada, unemployment rate has definitely moved up. So we'll see what Friday's number brings. Our next chart, CPI in Canada. We have core CPI. We have headline number, 1.7%, still fantastic, below the target. But it's that core CPI, when you strip out volatile food and energy. That number is starting to move back up and getting closer to 3% again, as you can see with the red line there. U.S. Consumer Price Index, our next chart. We've seen this chart many times, 2.4% on the headline and 2.8 on the less volatile food and energy number. And again, we're starting to see inflation numbers start very ever so slowly trickle higher. And one of the things I wanted to mention at this juncture in our show is this idea that people have been coming out with, the Trump administration, Secretary Bessent, talking about how tariffs do not increase, tariffs do not increase inflation, that it's a one-time effect on prices. So you might see a spike in prices, but then things slow down and inflation rate comes right back down, and it's really not inflationary over the long term. Well, I have a problem with that way of thinking. They are correct in that inflation measures the rate of change. So if you have inflation that's 2% this year and it's 2% next year, well, that doesn't mean that inflation hasn't or prices haven't gone up. It means that the rate of change hasn't increased. So it's 2% next year on top of the 2% this year, on top of the 3 or 4% from last year. So prices keep rising. So what inflation measures is the rate of change. So when you have a one-time shock to the system due to tariffs, you see a spike in prices, so that rate of change may go up to 4 or 5%. But then after that, it doesn't keep going up by 4 or 5% because those prices are now entrenched in the economy and they stay the same. So government will say, you see, inflation came back down. It's not moving as high anymore. But the average person out there going to buy groceries, going on a trip, looking to buy a car, whatever, big ticket items for your home, those prices will remain elevated and continue to increase from an elevated level. Very rarely, I don't remember actually ever, we see prices decrease. They only go higher. So if we get a big jump in inflation and spike in prices, and then it comes down to 2%, well, that's 2% on the 5%, let's say, that it spiked higher. And just people just can't handle that. People are already strapped. Prices are already high in the US, Canada. So tariffs will just add to that. So yeah, you can make the argument that tariffs aren't inflationary over time, but I'll make the argument that it all adds up and prices do go higher. Our third point that I wanted to touch on for individual investors to consider is the upcoming earnings season. Of course, that will start up. It looks like Bank of America, JP Morgan Chase, I think they're all reporting on the 14th, Citigroup, Wells Fargo, a whole mix of banks. And TSMC, Taiwan Semiconductor, will also report. I believe they're coming out on the 17th. And they are a very important company to tell us how artificial intelligence chip making is going. And I have a few charts to show. First one is Goldman Sachs. I think earnings from Goldman Sachs will be fantastic. We're hearing more and more about the IPO market. We're going to show a chart on that in 1 second. But you can see here how well Goldman Sachs at all-time highs. Once again, the chart looks fantastic. Let's show the IPO chart that we have. You can clearly see that IPOs have increased significantly. There it is. IPOs have increased significantly, especially tech IPOs. Tech IPOs are outperforming everything else pretty much, 108% versus non-tech IPOs. But the main point for our conversation is that trading has come back, and that is definitely going to help banks and investment companies like Goldman Sachs and Morgan Stanley. Not to mention Morgan Stanley has a huge wealth management business. JP Morgan, our next chart, the largest bank in North America. It's had a fantastic run because of the idea that the United States is reducing regulation on businesses, being able to help businesses grow. And what do they do when they need to grow? They borrow money. And where do they go? They go to places like JP Morgan. They go to places like Wells Fargo, Citibank. And these are the places they go. And that helps companies like JP Morgan and their profits move higher. Interesting to see what they say with respect to net interest margin, which is the difference between what they lend money at and what they pay out on their fixed income products, their GICs or certificates of deposit, as we say in the US, and how much they set aside for bad debts that they anticipate that people will have. Our last chart, Taiwan Semiconductor, Also a tremendous run, almost looks like JP Morgan chart, actually. And keep in mind, Taiwan Semi, they're the ones who manufacture the chips. It's the NVIDIAs and the AMDs and the Apples and a lot of the hyperscalers now, Microsoft, Amazon, they create and design the chips. But Taiwan Semi is the biggest manufacturer of the chips. Now they have some huge plants in the Arizona area in the United States, and they've definitely brought a lot of business to the U.S. Over the last, I guess, last year or so. So corporate earnings season. Keep an eye on corporate earnings. Have an eye on that. An eye on all the trade negotiations, all these letters that are coming out, and the economic data. We always like to talk about the economic data because this, or those three things, I should say, will be very important as to what type of investment decisions you make with your portfolio over the next couple of weeks. Yeah, if you can believe it, the worst start for the US dollar in 50 years. Wow. And we've been a bit of a benefactor of that. The Canadian dollar has gone up a little bit versus the US dollar, not nearly as much as other currencies, and we'll show that in a moment. And I think it's because Canadian dollar is weak as well. Obviously, we're having problems with GDP or growth in our country. We're having issues, obviously, with the tariffs, all the different tariffs that have been put on a lot of the goods that we send, a lot of the things we pull out of the ground and send to the United States. So our economy is slowing. Our debt levels are rising because our governments are trying to help people stay in their jobs and spending more money to keep people employed, even though that doesn't increase growth for the country. Keeping people employed hopefully allows them to be able to pay the bills and maintain their standard of living. But US dollar has been falling a lot more versus the rest of the world. And again, a lot of it has to do with the increased debt that the US has taken on. Let's show our first chart here. As I mentioned, major currencies of the world. And you can see the orange, which would be the Swedish krona. The Swedish crown, it is the best performance. And again, versus the US, which is at the bottom there, negative 9.47%. The Swedish crown, 16.74%. Canada, are we there? No, but we have our dollar. Yes, it is in blue, and that is doing better as well. The yen, the euro, all the major currencies around the world above the zero or the flat line mark, whereas the U.S. dollar is definitely struggling. Our next chart here shows the U.S. dollar. We call it the U.S. dollar, the Dixie, year to date. Wow, we can see that the dollar has definitely retreated this year, a tiny bit higher towards the end of that chart. We've seen the dollar stabilize recently, and that's probably what that is showing. But make no mistake about it. In 2025, our dollar has, the U.S. dollar has taken it on the chin. Our dollar as well. You know, our dollar is going lower versus the European, the different countries, the euro, the UK, the pound, Asian currencies as well. So our Canadian dollar is not faring as badly as the US, but not doing that great either. Our next chart, US dollar has suffered its worst first half of the year since 1973. There it is there. And that's why we say in about 50 years. And you can see the chart not doing so well. The bottom of the right-hand side of that chart is definitely falling. So we need to keep an eye on the US dollar. One of the main reasons why gold has done as well as it has, when the US dollar is losing its value around the world, gold is something that benefits. Gold is priced in US dollars. Oil benefits a little bit, priced in US dollars. US businesses, US international businesses benefit because when they do business in other countries and they repatriate those dollars, bring back those dollars back to the US, they get a bit of a surge because the US dollar has fallen as well. So I know President Trump talks about a strong dollar. Treasury Besant talks about a strong dollar. But I have to believe that a weak dollar at this time probably goes a long way for business in the US, especially the multinationals. And I would not be surprised to see the US dollar stay relatively weak, but then surge if we can get some trade deals down the road. I think those will be crucial once we get some stability with trade, once the economy starts to surge forward, if we can get by these trade negotiations, these tariffs, I think you could actually see a stronger dollar in the latter half of the back half of this year, stronger U.S. dollar. And what would that mean for our dollar here? Well, I think you could see a slight pullback. I don't anticipate a major pullback, but a slight pullback nonetheless. So let's keep an eye on the U.S. dollar and let's see what the effects are going forward on the U.S. and North American economies. So recently we had some mixed numbers out of the US in terms of their jobs. As I mentioned on Friday, we're going to get Canadian jobs. US came out a bit mixed. We had the private payrolls number, the ADP number, come out. We have a chart on that. We can show it. And it shows negative 33,000 jobs, a huge surprise. We were expecting obviously a positive number out of the US, private payroll number, and it came in negative. And that set this tone or stage for the number that came out last Thursday. You can see here, last time ADP or private payrolls was negative, you got to go back a few years. That's a monthly number, keep in mind. So you got to go back to, I guess, first half of 2023. The last time we saw a negative number. So that set the stage. What were we going to get come Thursday when we got the non-farm payrolls number? That's the big number that we all look at to see what the U.S. or how the U.S. would fare. Let's show that chart. And we can see the United States produced in June 147,000 jobs, in line with the previous 3 months. The unemployment rate actually dropped to 4.1%. Unbelievable number. So on the private payroll side, we saw jobs shrinking or job loss, but on the main number, we saw an increase. So how do you account for that? Well, very simply, it's government. Government are creating most of the jobs, if not all the jobs right now. State and local governments in the United States are producing the jobs. And that's basically how you account for it. We're seeing, as I said, pretty much rock bottom unemployment rate, full employment in the US at 4.1%. It's no wonder that the Fed is not in a hurry to cut interest rates when he sees jobs growth like this. Obviously, he's also looking at GDP and inflation data to make their decision on interest rates, but definitely strong jobs growth out of the US overall, but mixed, because when you factor in the private number, you're not so sure how healthy the jobs are in the United States at this time. Quick hits, 3 things that have been in the news over the last few weeks that I wanted to make a quick comment on that I think are important. In the US, the Fed's hunt for a reason to cut rates, surveys, and tariffs make answers elusive. As I just finished off the last segment, I think the Fed is trying to find a reason to cut rates, just can't seem to do so because I think they're nervous about what tariffs are going to bring. And as mentioned, things are going well. Why do you need to cut rates? Number 2, Musk talks about launching a third political party. If any of you saw in the news recently, Elon Musk said this is ridiculous. The fact that the One Big Beautiful Bill was passed and that there really was no party in the last election to challenge President Trump or Donald Trump at that time, former President Trump. And he's thinking about making a new party, calling it the U.S. Party for the people. And that was his conversation recently. Number 3, another topic I saw recently, which I thought was quite interesting, from fantastic to spoiled, how Japan's trade effort to woo President Trump backfired. And we heard in the beginning that the Japanese were trying to be the first to make a trade deal. Well, things have seemed to gone sideways and even down, because now we're hearing that a trade deal between the two countries is quite a ways away. So let's touch on our first quick hit. We have our first, chart here, which we can show, which is, the Fed trying to hunt for a reason to cut rates. And with a chart like this, how do you do that? And this is a survey, chief financial officers, CFOs, showing even firms who buy their supplies domestically expected to hike prices following the Trump administration of tariff announcements. So this is all about tariffs. This is the expected price as of Q4 24 is the red, the bar in the middle is first quarter 25, and then the orangey bar is second quarter 2025. And you can see this is the expectation from CFOs. So if CFOs are saying prices are going up basically on everything coming into the country and things that are actually built in the United States, how can or what reason does the Fed have to cut rates at that point, especially if unemployment's 4.1%, especially if they're growing jobs almost 150,000 per month. So I know President Trump has really hit hard. The Federal Reserve has come on very strong with Jerome Powell, the head of the Fed, calling him every name you can think of. Too late, Jerome. I think he's called him stupid and not smart and all the different things you can imagine. But give credit to Jerome Powell, the head of the Federal Reserve. He is hanging in there, and he continues to be non-political and continues to do, or the Fed as a group continues to do what they believe they should do. Our second quick hit, Musk calls for an American party. This is an interesting one that Elon Musk going back into politics, perhaps. He was in politics. He saw what that did to the stock price of Tesla. It basically cratered it. He left the politics for a little while. Stock price moved up based on that, based on him saying he's going to spend a lot more time at Tesla and other businesses. And now here he is once again weighing into the political sphere once again. And we have a bit of a quote here or some information. And it says, by a factor of 2 to 1, you want a new political party, you shall have it. When it comes to bankrupting our country with waste and graft, we live in a one-party system, not a democracy. And this is what Elon Musk said. Today, the American Party is formed to give you back your freedom. Independence Day is the perfect time to ask if you want independence from the two-party system. Should we create the American Party? And this was on X. So clearly stirring the pot once again, and I think not making the current President Trump, too happy. Our third and last quick hit is from fantastic to spoiled. What Japan wanted to do, they tried to woo the U.S. president, get him into making a deal with Japan. But at the end of the day, it just hasn't been in the cards. And when you think about what Japan is asking, they're asking for this automobile tariff, 25% tariffs on autos. I think that's a point of contention. Keep in mind that the negotiators for Japan have to go back to Japan and present in front of their parliament to get an approval of any deal that the U.S. and Japan discuss. And that's what's making it very difficult. We have one illustration about that. Trump's trade deal progress, tariff hike on imports. There it is, South Korea and Japan. And then there's some frameworks for, like I said, with United Kingdom, Vietnam, and China. So something to keep an eye on. As we mentioned earlier, a lot of trade negotiations and trade talks, but definitely in the news has been the talk with U.S. and Japan, and also U.S. with South Korea. So now a great part of the show, the best part of the show, in my opinion, where I get to take at least one question. And I know our show has gone on a little long today, but I'm going to take one question from the audience that has come in. I think this one came in over the last couple of weeks. And I wanted to take it because it's very different than the conversations we've had today. And it's on Bitcoin. Bitcoin climbed to a record high in March. Should I consider adding Bitcoin to my portfolio? And actually, Bitcoin is in around $110,000 US dollars right now, which is near an all-time high as well. And so Bitcoin, definitely not for the faint of heart, definitely not for everybody in their portfolio. I don't think digital currency such as Bitcoin is going away anytime soon. In fact, it's becoming more and more a fact of life. Digital currency, paying not with cash, but digitally with a card or using your Apple Pay or whatever you use as a consumer, we're seeing more and more of that. And in fact, many businesses today don't even accept cash. They want something, a card or some sort of Apple Pay and whatnot. So yeah, I think Bitcoin is here to stay. It is difficult still because the backing of Bitcoin is not by any means is it backed by the U.S. government, by the Canadian government, by any central banks. So it is difficult in that respect because if you should buy Bitcoin or other digital currency and where you bought it or how you bought it, if that place is not a legitimate establishment, then I've seen people and I've heard many horror stories that people can lose a lot of money. So I guess my comment is Bitcoin not going away, but perhaps not for everybody to make an investment in at this point in time still, even though we've seen Bitcoin rise significantly over the last few years. So with that, I want to say thank you to everybody that tuned in today to our show. I hope it was very informative. We definitely had a lot of illustrations, a lot of charts. And I also want to say that we will be back 2 weeks from today, 12 noon, across all social media platforms with our next episode. And on our next episode, which is, as I said, 12 noon Wednesday, we will have Catherine Cobden, President and CEO of the Canadian Steel Producers Association. She's going to give us the lowdown as to what's going on with negotiations with respect to steel. Perhaps we can even ask her about some other metals. We want to know what's happening behind the scenes and what we can do here in Canada to combat what the US is doing with respect to steel tariffs. So it promises to be a fantastic show, a fantastic interview, and I hope you all can tune in 2 weeks from today at 12 noon again. But until then, I want to wish everybody a happy investing.